Hi, I'm Siu Ling Hui with part 4 of a video series about the cash flow statement. This video is about the investment activities section of the cash flow statement. Investment activities here doesn't mean just buying shares, although it can include this. Investment activities covers expenditure on assets that you use to help you generate future income in your business. Let's take a closer look at what goes into this section of the cash flow statement. The most common investment activity for businesses is capital expenditure, which is often referred to simply as CapEx. Capital expenditure in the cash flow statement shows cash payments for purchases of things like plant and equipment, cars, computers, land and buildings, and so on. If you construct buildings for your own use, the progress payments that you make on the building costs during construction are included here. These assets are classified as fixed assets or property, plant and equipment, or PP&E for short, on your balance sheet. So cash outflows here will mirror an increase in these assets on your balance sheet. Even if you finance the payments for these purchases with borrowings, you will still show the purchase price as a cash outflow here. How you finance the purchase is reflected in the finance activities section of the cash flow statement. Investments in other businesses or joint ventures, as well as expenditure on developing intellectual property, are also shown in this section of the cash flow statement. If you sell off any fixed assets or sell your investments in businesses or joint ventures or intellectual property, the actual proceeds from the sale are included here as cash inflows. Note that this is the actual cash received and not the profit or loss made on the sale of these assets. The cash flow statement is about cash, not the accounting profit or loss. Let's walk through an example of a car that is bought for use in the business. Let's say the business buys a car for $4,000 at the start of year 1. The $4,000 is capital expenditure. It is shown as a cash outflow in the investment activities section of the cash flow statement, regardless of whether it was financed with debt or out of the business's own cash. In accounting, there is a concept called depreciation of fixed assets. Depreciation reflects the cost of using the fixed asset to produce income over the asset's useful life. Most fixed assets, apart from land, have finite useful lives. The useful life for the different types of assets are usually set out under the tax rules. For this example, let's assume the car has a useful life for accounting purposes of 4 years. It doesn't matter that the car is perfectly usable after 4 years. From the accounting standpoint, the car is worth nothing after 4 years. So in this case, the purchase price of the car will be spread over 4 years. Each year, $1,000, which is the purchase price of $4,000 divided by 4 years, is charged against the profit and loss as depreciation expense, assuming that you are applying what is known as straight-line depreciation. Don't worry too much about these technical terms. Your accountant or bookkeeper will know what depreciation rates need to be used. Depreciation expense is a book entry. There's no cash involved with this expense item. That's why it's added back to net profit when we are working out cash flow from operations. Now, let's say we sell the car for $3,000 after using it for 2 years. Each year, the value of the car on the balance sheet is reduced by $1,000 in depreciation expense for the year. That means we have accumulated depreciation of $2,000 against the cost of the car by the end of year 2. So the depreciated value of the car on your balance sheet is $2,000. That's $4,000 cost minus accumulated depreciation of $2,000. From the accounting standpoint, we have made a profit of $1,000 on the sale of the car because the car was worth $2,000 on our balance sheet at the end of year 2, but we sold it for $3,000. But if we sold the car for $1,500, we would make a loss of $500. Sale price of $1,500 minus the depreciated value of $2,000 gives us a loss of $500. However, in the cash flow statement, we are only interested in the amount of cash received on the sale, not the accounting profit or loss. So, if we sell the car for $3,000 and make a profit of $1,000, it is the cash received of $3,000 that is recorded as proceeds from sale of assets in the investment activities section. If we had sold the car for $1,500, then we would have cash inflow of $1,500, even though we made an accounting loss of $500 on the sale. The cash flow statement is about cash in or cash out. Whether it's a profit or loss is irrelevant here. But what happens to the profit or loss on sale of the car? This profit or loss would have been included in the calculation of net profit in your profit and loss statement. It is eliminated in the adjustments made in the cash flow from operations section. We deduct the profit on sale of the car to get rid of it from the net profit figure. If it is a loss, we add it back to the net profit. Why add back? Because our net profit in the profit and loss statement was reduced by this loss on sale of fixed asset. So we have to add it back. By doing these adjustments to the net profit figure under the cash flow from operations section of the cash flow statement, we eliminate the profit or loss effect of items that relate to investment activities, like sale of fixed assets. The same principles apply with sale of investments in other businesses, joint ventures, intellectual property, and so on, except that you don't have depreciation expenses for these items to adjust for. Instead, there could be amortization for intellectual property like patents. Amortization works the same way as depreciation. Think of it as the depreciation equivalent for things that aren't of the nature of property, plant, and equipment. If you want more information about any aspect of the cash flow statement or financing in general, please put your questions below in the comments or contact me through the contact page at incontextfinance.com. Master your cash flow, know your finances, so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.